With the asset prices rising and wages remaining stagnant, we have encountered a big problem. There's no way to turn this around. Housing is way too expensive for the average person. Food and energy is rising. But have no fear. Helicopter Ben Bernanke will save you. You came here for the truth, so let me unveil that for you. We're going to get into several topics today, but I wanted to begin with asset prices, specifically real estate. Affordability dips. U.S. home prices were at the least affordable level since, guess what, 2008. This is where we need to be focusing our attention on. We can see that we have hit the same level that we were at in 2008 yet again. There are hundreds and hundreds of indicators showing us that we are in this territory. That's not good. When you look at mortgages being more expensive now than they have been in a long time, and the average person's been relying on cheap credit in order to continue to expand this fraudulent system, we have ourselves with a little predicament. I'll show you the article here out of Bloomberg. Now, Atom Data Solutions, a website I've showed you before, shows the average wage earners would need to spend 31% of income, let me highlight this, to buy a medium-priced home this quarter above the historic average of 29.6%. So we're looking at the average person using a large percentage of their income to be able to buy their shelter. Same goes with food and energy. Those are rising as well, as I mentioned. Home price appreciation, coupled with rising mortgage rates, have pushed 3/4 of average wage earners out of the market, with property costs rising faster than wages in 64% of regions surveyed. Home price appreciation continued to outpace wage growth, speeding up the affordability treadmill for prospective home buyers, even without the rise in mortgage rates. So just looking at the home prices themselves, we have a problem. But then add on top of that interest rates rising, and the average person is unable to afford it. 75%, 3/4 of people are unable to buy a home right now. Sure, they can buy a home. They can do it. Many people are, but they can't actually afford it. That's the difference. I did videos about this before, and I was criticized. People were telling me, I bought a home. I know what I'm doing. This is my second home. This is my third home. And I just keep getting the echoes from the past. I've heard this all before. We were told during 2006 into 2007 that this was the greatest thing since sliced bread. Offering people homes who normally couldn't get them before is amazing for the economy. It's so great for the individual, and the American dream can finally be fulfilled. All we needed to do was sweep up everything under the rug. Nobody will notice. Now, in that article, it talked about the fact that the median house price was under $300,000, something like $260,000 or $280,000. And I wanted to compare that to Canada. Median home price is over $500,000. We are looking now at this time to be so expensive. Now, if you compare the average wage of the US to Canada, it's practically the same. So the affordability is much, much worse. And this is the nation as a whole. It's not really fair to take a nation as a whole and compare housing prices. I get that. But you can take specific markets and look at it, and I assure you, where the population resides, where the majority of the population resides, housing is too expensive compared to wages. Add on top of that rising borrowing costs. We've got a problem. We've got a big problem, and it's not being addressed. I don't care if I'm ridiculed. It really doesn't bother me. Facebook is taking everything we have and giving us what? Nothing. Just pain in our lives, said the preschool teacher and restaurant worker seated inside her dimly lit apartment a mile from the company's headquarters. Facebook is just ruining the community. It's an interesting article here. I'm not going to read it all to you, but Because of what's happened with Facebook, because of what's happened with these areas, Silicon Valley, where we do have more jobs moving in, we do have more population moving in, and housing prices have appreciated drastically. But it's not all good news. The displacement of working class and low-income Latino families in the shadow of Facebook's behemoth campus, which is undergoing a major expansion adjacent to their homes, offers a stark illustration of California's housing crisis and expanding income inequality. By many measures, the tech industry has in recent years exacerbated the crisis of evictions, homelessness, and poverty. Okay? It goes on to talk about the details here, what they're going to do about it, what they intend on doing. I think that we've got an issue that is clearly highlighted right here, whether it's San Francisco or other areas of California, Manhattan as well. This is not, something that will be a good sign for the future, not just of California or the Manhattan or these other areas, but if prices are allowed to continue to appreciate, it's only going to make matters worse. You have displaced people, that only adds to unemployment, that only adds to people living on the streets, and so on. So this is the type of issue that, I cover it often, but I do think it is very important to continue harping on it, continue focusing on it. I want to step into some other issues right now. You can now gorge guilt-free 1-month bill yield on par with S&P. Chalk up another win for U.S. Treasuries. First it was the 12-month bill, then the 6-month, then the 3. Now the interest rate on the 1-month Treasury bill is close to overtaking the dividend yield on U.S. stocks for the first time in a decade, underscoring why the risk-free, supposedly, short-term government debt is trumping the allure of stocks for income-hungry investors. We have seen investment firms pulling money out of the stock market, believe it or not, despite what you see, pulling money out of the stock market. Perhaps this is one place they're putting that money. They're uncertain, so they feel some level of certainty here. Now, guess what? Yet again, 2-in-1 video, we are heading back into the crisis territory. This just happens to be, for this one particular instance. But how many indicators have I shown you? Cash is king. In decade first, S&P dividend yields relative to 1-month treasuries is close to 0. That right there is yet another warning sign. It's not good to see this type of thing happening. But I don't put too much stake into it at all, of course. It isn't uncommon in the oil industry. By the way, this article is talking about Guyana, and this is one country that's been rather silent. I don't know how much information I've been covering here on this channel over the years. Very rarely. But if you look at where Guyana is, you think you got Venezuela nearby, you got Brazil nearby, other countries here that are resource rich. You would think Guyana would also have that. Well, that brings me to this point here. Exxon, years ago, started to look around to see what they have under the ground, and they did strike oil. So they're talking about this situation in Guyana, and they're going to say, look, what do we got to do to steal all your oil and give you pennies for it? And so they're deciding to make a deal right now. The people, of course, aren't happy, but I do believe that this will at least bring some jobs in. I don't know how unfair the deal is going to be, but the people aren't happy because, of course, they always get screwed over. I have to figure that's going to happen. It isn't uncommon in the oil industry for the first investors to get the best deals because they assume more risk. Exxon didn't discover oil in Guyana until 2015, 16 years after it signaled an exploration contract, but critics said the government should have demanded better terms when Exxon renewed the contract in 2016. Exxon took advantage of our weak bargaining position and are inexperienced, and they were able to extract everything they wanted. The IMF, which is advising Guyana, by the way, recently recommended the government halt granting new licenses until it can secure better terms and overhaul its tax structure. Can you believe it? The IMF is actually telling them, hold on, wait for better terms. But I'm sure they're all on the inside together. It doesn't really matter. Now, they're going to go in there. They're going to take everything from Guyana. That's for sure. The people, I'm hoping at the very least, are going to, let's say less unemployment. That's what I'm hoping for. Hoping for more people employed, getting the jobs, and they're getting people working, getting buildings happening, getting the restaurants open, this and that. The resources, that's up to the politicians to decide, and hopefully they'll work out a good deal. But I just thought it was interesting that Guyana remaining quite silent for the past few years. Haven't really heard much about them, but in a place where there's surrounded by a lot of resources such as oil. I just wanted to touch on this couple points very quickly, okay? U.S. debt to GDP. I've shown you this chart before, but I think it's important to cover it regularly. Take a look at where we are. Take a look at where we were back in 2008. It's gone further. It's gone higher. Look at back in the year 2000. Then we look back in 1946, where it peaked out. We're basically at the same level today. I mean, we're not even factoring unfunded liabilities. And that's what it comes down to. When you look at a government statistic, especially something like debt to GDP or debt in general, make sure that you are factoring in that which is off of the balance sheet. Unfunded liabilities are not accounted for, and that is so important, yet obviously they're going to take it off. Look at all these corporations which hide all of their bad debt off the books, and they're allowed to do that. One of the recommended books, if you go to the link in the description, I have all my favorite books there. One of them is by Frank Partnoy. It's a relatively unknown book. I've never heard anybody else talk about it. I don't know how I found it, probably just through Amazon recommended reads. But when I read that book, it talks about how they actually accomplish that. And basically they can push off any bad debt into, indefinitely, into the next quarter until the time is right. They can do that. And they do. He explains how it's done. Federal debt plus unfunded liabilities, and you can see that here in the red lines here, and understand what that means here. These numbers have continued to escalate at rates, quite frankly, we're not able to support. No country can support this level. It's astronomical. Whether it's at 400% or not, I don't know, okay? There's different calculations for how you can come up with these numbers. Whether it's at 100% or 400%, it's never going to be paid back. It's just a matter of fact, okay? And then last but not least, so there are a lot of people who are in debt. I talked about credit cards recently. I talk about the debt situation. I talk about mortgages, about borrowing costs increasing. And yet at the same time, we have individuals who are buying things that, as far as I'm concerned, are not exactly a high priority. Luxury sneakers. Yes, I said that right. Luxury sneakers. High style and a booming market. So there are people paying, we've seen this before, limited edition shoes, and they come out and the people unfortunately lose their lives because of those shoes, literally. I've shown you those statistics before. The news brings it out there. Literally losing their lives because of a pair of shoes. That's the level that we've stooped to today. Shoes are just one example. I mean, there's all kinds of things. Shoes get you from point A to point B, okay? There are definitely nicer shoes than others, but in this article it's talking about second and third hand pairs of shoes going for tens of thousands of dollars in some cases. And that's rare cases, but still. I mean, it's ridiculous. What's going on? What kind of bull market is this? Are these really collectibles? I guess some people can afford them. However, we need to understand what the true value is. There's a lot of people who are talking about cryptos and how they are, made of nothing and they're worth nothing. It's all based on what people perceive the value to be. That goes for anything. If somebody's willing to pay $10,000 for a pair of shoes, clearly there's a buyer out there willing to pay that money. It goes for any asset, okay? I just wanted to finish off with that, and I hope that you do understand how what I'm trying to get to. If you found the video informative, please give me a thumbs up. When you give me a thumbs up, it helps to support this channel. I do appreciate that very much. And of course, if you want the financial education you were never taught in school, you went to school all the way through, never learned a single damn thing about finances, about how to profit, about how to make money, about how to protect what you have, these 2 books have it all. If you're interested, you can flip through the books at Amazon. There's a link in the description of this video. If you're more interested in the audiobook version, that's available at themoneygps.com.